Which one is me? Which one is Jim Grant? Look at that. Look at the difference there. I mean, come on. It's a trending style. And his book, bring up his book, The Gilded Age, A Life and Times of Thomas B. Reed. Mr. Speaker, we talked about this before. What an interesting snapshot to the 1890s. I want to bring up a chart which we're introducing here, long-term view. We've showed it before, inflation-adjusted gold. Is this a gilded age, and does gold and the tensions around it signal the polarity of income and wealth distribution that's out there?
Huh?
Does gold signal the polarity like in the 1890s? He's being tough today.
When I get home, I'm going to look up the word polarity.
Polarity, the barbell,
as for what gold might mean, it seems to me that gold is the mirror image of the world's faith in the likes of Ben S. Bernanke, PhD, and that to the extent the world has faith in his powers of forecasting, judgment, then gold is rather marginalized. It was marginalized when Alan Greenspan was about to be canonized while living. That was about 1 million years ago. For the past 10 years, the world, I think, quite understandably, has lost its unquestioned faith in the institution of central banking, and gold has done much better. Gold being kind of the legacy currency, it being the original monetary medium.
How do you respond to the many people that I'm sure write you and say we have to go back to the gold standard?
Well, I egg them on. What we need is a form of money that cannot be materialized on a computer screen at the whims of a committee of public servants, that being our current PhD standard. The gold standard was by no means perfect. It was, however, I think, the least imperfect monetary system ever devised. What it would deliver today is a sense of balance in the world as it is today. The debts pile up on one side of the world, and the bonds the assets pile up on the other side of the world. In the days of the gold standard, there was a balance in the world. No one country came to own all the junk or the stuff as we do. America has the stuff, and China has the bonds. And what is wanted is a greater balance between debtors and creditors.
Yeah, let's look this up. The two-year yield here, and this is the hangover version McChesney-Martin, which is just a two-year yield driving lower as we take away McChesney-Martin of 1951 Accord, his punch bowl. I mean, we're beginning to pull that away, aren't we? July 1st, QE2's over.
Right, well, QE2 is over. And there's
big success, huh?
As defined how, Tom?
I'll let you define it.
Well, it was a success in raising the rate of inflation. That's good. Oh, no, it's not good. It's not good. It was a success in raising the rate of unemployment, or at least, no, that was not so successful. Without being facetious, QE2 did not deliver what it was promised to deliver, and it seems to have delivered much that was not anticipated. One of the consequences of this ultra ease and with 0% interest rates is our current difficulties in money market mutual funds. Now, I have been taken to task.
Huge.
I have been taken to task by the money market mutual fund business for failing to emphasize properly the care with which the money market funds have separated themselves from the obvious trouble spots in Europe. Greece, for example. Very few assets in Greece. The point, however, is not whether the funds have dodged that bullet. The point is that in a 0% funds environment, these money market mutual funds are taking some credit risk in Europe with zero reward for that risk.
Zero reward and also risk to principal. Only a penny or two makes a big difference, doesn't it?
You're not in these funds to make a buck. You're in the funds to keep a buck.
Right.
And so why take a risk for 1 basis point at which your money doubles once every 6,932 years?
Here's an op-ed.
Was that an impressive fact?
Yeah,
no.
Yeah, that was a good fact. Bring this up here. Marty Feldstein, I thought, synthesized together as Jim Grant does. Fiscal policy will actually be contractionary in the months ahead. Fiscal stimulus, the free lunch is coming to an end with stimulus declining 400 down to 137 billion. He'll be with us tomorrow morning, 8:30 roughly, with Bloomberg surveillance. I thought that was a nice summary of after all of this action, now we've got that fiscal drag coming in as well.
Well, I think from my mind we could, I don't know. I'm not sure that the fiscal stimulus is the is the answer to our troubles. It seems to me we've had a great deal of fiscal stimulus without much to show for it.
When you look at, and I'll bring up chart 6 if you would here. We already did chart 6, excuse me.
Chart 6 was so good we might see it twice.
You're going to see it twice here with McChesney Martin. I mean, the low rate environment goes against your call. Clearly, it's policy driven. When we're finally done with this, is it a smooth flow to higher granteeing yields, or could we see some real instabilities?
Yes.
He's a surly Jim Grant this Thursday.
I'm not sure how to answer that. So many birthday candles have I blown out that I'm not in the business of soothsaying over the near term. Near term for me being about 35, 40 years.
Here's a Jim Grant quote here from one of his letters, Grant's Interest Rate Observer. Teensy tiny funding costs distort prices and valuations in every class of investment asset. Tattoo that to your brain when you get the free lunch of yield. Strange things happen. That's what we saw from Martin Feldstein's comment as well. We're going to come back with Jim Grant, author of The Gilded Age, terrific book on an important Speaker of the House at the turn of the last century. Jim Grant with us, of course, so much to talk about. Let's talk housing. Not much in his recent notes, but it's that distortion in prices that Mr. Grant was talking about. I made this chart this week, Jim. This is housing back 1,000,000 years in $2011. And essentially, we've taken away the boom. Just simply, we've gone back to normal.
My grown children have a kind of a naughty phrase. They say beer goggles, meaning the charitable perception that comes over one after a pop or two with respect to a member of the opposite sex. That's beer goggles.
Really?
Investors, collectively, unknowingly, have been wearing interest rate goggles through the prism or the lens of 0% funding cost. We collectively have seen assets in a new and charitable light. We saw house prices as if they were things of beauty in the early aughts. We see equities in a different way, commodity prices a different way. 0% funding costs are a source of terrific distortion, much of it pleasurable.
And this quote, Sarah, bring up this quote if you would. Bondholders trust like beagles. That's the most important single sentence I saw in 3 or 4 of your notes. That trust out there. Well, these low yields.
It's trust also, it is muscle memory. Don't forget interest rates, I know you don't, but bond yields, interest rates have been falling or going sideways, mainly falling since 1981. That is 30 years of conditioned behavior. Yeah. And nothing succeeds like success. Nothing sticks with one like the recollection of a terrific run, and 30 years is a long time.
Another Jim Grant quote here from, you could pick out like 25 quotes out of a good 5 pages. This is on England. Dalton is 1945. Think Churchill, think Labour, think some really difficult.
Think 2 meals a day.
2 meals a day. We are bearish on sterling, but stand in awe of its pluck and longevity. It has more lives than a cat. You could bring that in the Jim Grant view over to the United States. When are you going to be right about significantly higher yields when you're struck by that awe of sterling, or for that matter, the U.S. experience as well?
Well, there is a great deal of ruin in a nation, as someone said, and there is a terrific amount of sheer habit in people's use of a currency. Sterling ended its reign as the world's reserve currency in one sense in 1914, another sense in 1931. Sterling was still an important reserve currency until the 50s, a generation after it had positively and decisively exited the stage as the great store of value in the world. So, there's nothing that says to the dollar because it is losing market share on the shelves of banks and central banks. Nothing says the dollar is going to go out of business. It's not going to go out of business, but it might well be supplanted as the one and only asset you need in monetary affairs.
30 seconds. Where do you invest right now? Where do you put your money right now?
We are looking increasingly at these great, big, cheap, unloved blue chips that have been going sideways for 10 years.
J&J is just one example?
Yeah, I mean, a lot of the composite blue chip would be priced at 10 to 11 times trailing net income, would be yielding 2.4%, would be buying back shares, would have a different clean balance sheet, and would be out of favor.
Very good. Jim Grant, thank you so much. Read this. It's a Jim Grant book. This is a terrific book. I can't say enough about this. This is the one just before. Mr. Market miscalculates. There's a lot of smarts in there. This is a pencil book. You've got to read this book with a pencil in your hand so you can argue, write down in the columns, Jim, I agree with you, Jim, I don't agree with you. That kind of ideas.